The sequence of returns trap. Welcome. You've worked hard to build your retirement savings. You've saved diligently, invested wisely, and you're finally at the point where you can see financial independence on the horizon. But here's a truth that surprises many retirees. It's not just how much you've saved that determines your success. It's also when you start taking money out. If the market takes a downturn in those first few years of retirement, it can do far more damage than the same downturn happening later on. And the reason is something most people have never even heard of: the sequence of returns trap. This trap can quietly drain your portfolio even if you did everything right leading up to retirement. And the most dangerous part, on paper, your investments could show the exact same average return as someone else, yet your outcome looks completely different, all because of timing. Hi, I'm Brandon Persia, partner, financial advisor at Starboard Wealth Advisors. For years, I've helped high net worth retirees and pre-retirees design income strategies that balance growth, stability, and tax efficiency. And one of the biggest risks I see overlooked time and time again is this very issue: the order of your investment returns once you start withdrawing money. So in today's video, I'm going to break it down for you in plain English: what the sequence of returns trap actually is, why it matters more than most people realize, and strategies that may help protect your income so you can retire with more confidence. If you find this helpful, don't forget to watch for our other videos for more practical retirement strategies. And if you're approaching retirement and want to see how this might apply to your own plan, you can use the link in the description to book a call with me, and I'd be glad to walk you through your options. So let's dive in. Part 1. What is the sequence of returns trap? Most retirees spend their working years focused on a single number: how much have I saved? And while that's important, once you retire, a very different question takes center stage: how long will my money last once I start using it? This is where the sequence of returns trap comes in. So here's the idea behind it. When you look at your investments, you often see an average return over time, maybe 6 or 7% annually. So it's natural to assume that as long as your average return is healthy, you'll be fine. But averages hide a dangerous truth, because what really matters isn't just what your returns are, it's when they happen. So imagine you have two retirees, each with $1 million saved, and both plan to withdraw $50,000 a year, and both average a 6% annual return over the course of retirement. Retiree A experiences strong returns in the early years and weaker returns later on, while retiree B experiences poor returns in the early years and stronger returns later. On paper, their average return is identical, but in practice, their outcomes couldn't be more different. Retiree A enjoys steady withdrawals for decades, while retiree B risks running out of money much earlier. Why? Because of the sequence of returns. When markets fall at the very start of retirement and you're simultaneously withdrawing money to live on, you're forced to sell more shares at lower prices. Those assets are gone. They don't get the chance to recover when markets bounce back. So think of it like climbing a mountain. If you lose your footing near the base, you still have plenty of ground to make up for it. But if you slip right at the top with little room left to recover, the fall is far more damaging. That's exactly what happens when the sequence of returns trap. Losses early in retirement magnify the risk of depleting your portfolio too quickly, even if, over the long run, the numbers suggest you should have been fine. And that's why retirees who only look at averages without considering the order of returns are often caught off guard. Part 2. Why timing matters so much. Once you start taking withdrawals, every market loss is magnified. Think about it like this: when you're still saving, market drops can be opportunities to buy more at lower prices. You've probably heard the saying, buy low, sell high. But in retirement, it's just the opposite, since you're now selling assets to generate income. If the market is down and you're forced to sell, you lock in those losses permanently. Your portfolio doesn't just need to recover, it has to work harder to rebuild while you're still taking money out. So let's say another situation where you start with $1 million and withdraw $50,000 per year. If the market drops 20% in your first year, you're now pulling $50,000 out of an $800,000 portfolio instead of $1 million. That higher withdrawal rate accelerates depletion. That's why retirees who encounter poor returns early on face far greater risk than those who encounter them later. Part 3. Real-world example of the trap. Concepts are helpful, but numbers make this risk real. So let's walk through another example. Imagine two retirees, again we'll call them retiree A and retiree B. Both start with $1 million in retirement savings. Both withdraw $50,000 per year to cover living expenses, and both earn the exact same average rate of return over a 25-year retirement, about 6%. But here's the twist. Retiree A experiences strong positive returns in the early years, say plus 15%, plus 10%, plus 8%. 8% in the first 3 years before encountering downturns later, while retiree B experiences poor returns in the early years, say down 15%, down 10%, down 8%, before enjoying the same strong returns later. At the end of the 3 years, retiree A's account balance is larger than when they started, whereas retiree B's account balance is smaller than when they started. On paper, their average return over 25 years is identical, but in practice, their outcomes couldn't be more different. Retiree A is able to keep withdrawing income year after year, even after 25 years, and still has a meaningful portfolio left, while retiree B, despite earning the same average return, depletes their portfolio much earlier. Why? Because those early years combined with the withdrawals reduced the portfolio so much that the later gains could not make up the difference. Think of it like filling 2 buckets with water. Retiree A's bucket will start strong, it's filled up early, so even if it leaks later, there's still water left. While retiree B's bucket starts with holes at the bottom, so by the time water gets added later, too much is already drained out. That's the sequence of returns trap in action. 2 people, same savings, same withdrawals, same average return, yet one ends up secure and the other faces running out of money. Here's the most part people miss the most. If you only looked at the long-term average, you'd assume both retirees were in great shape. But averages hide the story of timing, and timing is what makes or breaks a retirement plan. Part 4, strategies to help manage the risk. I'd like to talk about 5 of those today. Strategy 1, build a cash or income reserve. One way to reduce exposure is to hold a portion of retirement savings in cash or very stable assets. This gives you a cushion to draw from during a market downturn, so you don't have to sell investments at depressed prices. For example, having 1 to 3 years of expenses set aside so that can help smooth out withdrawals during volatile periods. Strategy 2, use a bucket strategy. That's a strategy that divides your retirement savings into different time horizons. Short-term bucket will hold cash or bonds needed for the next few years. Medium-term bucket holds balanced investments needed for the next 5 to 10 years. And a long-term bucket consists of growth-oriented assets for later years. This way, your income isn't directly tied to stock market swings in any given year. Strategy 3, flexible withdrawal rules. Instead of taking the same dollar amount every year no matter what, some retirees adjust their spending based on market performance. For instance, you might withdraw slightly less during down years and increase spending and travel when the market is strong. This flexibility helps reduce the pressure of pulling money out at the worst possible time. Strategy 4, diversify beyond just stocks and bonds. For high net worth retirees, this may include incorporating other sources of income such as real estate, alternative investments, or annuity products depending on your risk profile and needs. The goal is to reduce reliance on a single asset class so that a downturn doesn't derail your entire plan. And strategy 5, tax efficient withdrawal planning. That includes taxes and sequence of returns are closely linked. If your withdrawals aren't tax efficient, you may be forced to pull more money out than you actually need, further stressing your portfolio. Coordinating withdrawals across taxable accounts, IRAs, Roth IRAs, and other income sources can help balance sequence, risk, and your tax exposure. In part 5, why professional guidance matters. This is where working with a financial professional can make a big difference. Stress testing your retirement plan against different market sequences helps reveal whether you're prepared or vulnerable. A plan isn't just about how much you've saved, it's about ensuring that money lasts through both good and bad cycles. The sequence of returns trap is one of those most overlooked risks in retirement planning. It's not just about the size of your nest egg, it's about how and when you draw from it. The key takeaway, build flexibility into your plan. Whether that's through reserves, diversification, or smarter withdrawal strategies, the goal is to avoid locking in losses during down markets. If you're approaching retirement and want to make sure your plan is working for you, not against you, then let's talk. Click the link in the description below to book a complimentary consultation, and I'll help walk you through your options so you can select the most appropriate one for you and your family. Remember, Starboard Wealth Advisors, your financial destination, is why we're here. Thanks for watching, and if you found this helpful, make sure to watch our other videos for more clear, no fluff retirement guidance, or you can contact us for a simple phone or Zoom call. See you on our next video.